Hi everyone. Today I am planning to discuss a special topic from our YouTube channel which will be beneficial for you. Sometimes you may be already an investor who has purchased stocks from a listed company, or sometimes you may be a future investor who is expecting to invest in the stocks of a company. So you may be thinking of selling your stocks and purchasing another stock which will add a value to your portfolio. Or sometimes you may be a person who already has money and expecting to buy stocks. So whoever you are, your expectation is to get a good return for your investment. Investing in a stock is always a risk because you cannot expect a particular return in the future. Sometimes your entire investment will be at a loss, or sometimes you may get more than what you expect. So there's always a risk associated with investment in stocks. So in order to minimize the risk associated with investment, you can do some analysis before you buy a stock. This analysis help you to spot a good stock. So we'll go through this. So the first thing you should consider is revenue growth. Any profit driven organization generate revenue. It's the main income source of the organization. So any investor need to look into the revenue figures of the organizations. So you just by looking at the figures of a 1 year, you cannot decide this revenue is good. For that, you need to analyze 4 or 5 years revenue figures by analyzing the financial statements of the organization. For public listed companies, there are published financial statements. So you need to analyze these financial statements and identify whether there is any revenue growth. You cannot decide the revenue is good or bad by just looking at the numbers. To do that, you need to look into the deeper into the revenue, whether this revenue is generated actually by the improvement of the sales or just by the increasement of the prices. Increasement of prices is just a situational things. It can be changed. If there's a deflation, prices automatically go down, revenue of the company also go down. But if the sales in numbers growth, it's the actual sales growth. By improving the number of sales unit, the organization can grow into new markets. It also results in increase in the market share of the company. So it's the actual or the real sales growth. Further, the sales revenue growth need to be constant. Sometimes any company can go into a merger or acquisition, and automatically this results in increasement of sales revenue. So we need to look into that matter also. Also, there may be capital gain, and also other spontaneous things will result in increasement in sales. So any investor should look into the real figure of the or the real picture of the sales revenue. So if the revenues are growing in a stable and constant manner, that's actually a less risky organization. We can expect that its revenue is actually growing. For example, let's assume that in 1 year revenue grow by 10% and in another year revenue grow by 25%. We cannot rely on those figures. There should be something hidden in those figures. So we have to look into that matter. So by analyzing these revenue figures with profit figures, someone can identify whether the sales are actually growing or not. So based on those realistic picture, you should spot a good stock. Let's move into the other factor, that is profitability. We know there are several profitability ratios: net profit margin, gross profit margin, return on equity, earnings per share, likewise. So anyone can use any of these figures to analyze the profitability of the organization. Profitability, just like the revenue, we cannot decide just by looking into 1 year figures. So we have to take several year financial statements and analyze those financial statements for these profitability figures. We know that profitability is something which is related to accounting treatment. So we know this profitability contains accounting policies, accounting misstatements, and those errors. Someone should look into the profitability with the cash flow figures of the organization. If the profit is backed by the cash flows, that is ideal for investments. Companies can show profits in whatever manner, but if there are no cash flows generated in the organization, that's a problem. The type of companies are actually not ideal investments. Actually, someone can take same company's financial statements over few years, or he can compare that company's financial statements with another comparable financial statements and look into those gross profit, net profit, ROE or PE ratios and decide the best investments. The only thing you should remember is don't just look into the numbers, reveal the hidden picture behind these numbers. Otherwise, you will be misled by those figures. Only after revealing the real picture of the organization you should invest. Other factor is debt levels. We know that debts are riskier. So when investing in common stock, an investor should look into the debt level of the organization. If the company has taken too much debt, that is riskier investments because these debts are contractual obligation. So whether the organization generate a profit or not, they have to pay the interest and capital repayment. In a case where there are no cash flows generated from revenue, the company has to sell its assets in order to settle those liabilities. In that situation, the equity holders or the investors who invest in common stock will not get any cash flows. Any investor has to look into the debt levels of the company. For that, he can look into the debt to equity ratio. If the debt to equity ratio is lesser than 1, it's a good investment. The risk is less. But if the debt to equity ratio is higher than 2, that's a risk investment. Also, they can look into the debt coverage ratio or interest coverage ratio. Interest coverage ratio tells the company's ability of paying the interest using its cash flows. Also, the debt coverage ratio tells the company's ability to pay both the capital and the interest using company's cash flows. So if those ratios are at a good level, you can spot it as a good stock. The other one is valuation. The other factor you should consider is company's valuation. Through valuation, investors can identify the actual value of the stocks. We know that there is a market price for a stock. Actual value of a stock vary from the market value due to various reasons. So through valuation, we can identify the actual value of the stock, so decide whether the stock is fairly valued, overvalued or undervalued. There are many methods that we can use to value a common stock: dividend discount model and free cash flow methods, and also the relative valuation methods like using P ratios, book value ratios, those revenue ratios. Likewise, there may be good companies whose stocks are overvalued, which means market price of the stocks is higher than the actual value of the stock. By investing those stocks, you lose your money because you pay higher value for the stock which is actually not worthy for investment. And there are other companies, those companies are really good companies, but their market price is lower than the actual value of the company. So by investing in those shares are undervalued shares, you can actually gain for your investments. So in order to do that, you can analyze or decide the value of the shares through a professional valuer. Also, your broker in company may assist you in that. But before you decide on investing in stock market, you should have the basic knowledge that market price of the stock is actually vary from the actual value of the stock due to various reasons. So spotting the stock with the right price at the value to your investment. As an investor, the other factor you should consider when spotting a good stock is dividend growth. As an investor, you invest in stock with the expectation of return. There are two main return for a stock investment, that is dividends and capital gains. So dividends are the revenue of investors. Having a good higher dividend compared to other companies is really essential for your investment. But just by looking at the dividend, you cannot decide whether this stock is good or bad. For that, you need to look into the where the dividends are growing. If the company has growing dividends, that is actually a good investment. You shouldn't just look at the amount of dividend, but also the growth of the dividend. If the dividends have constant and stable growth, that gives a signal that's a good stock. Dividend growth means company's profits are growing constantly, also stable manner, and also it reflects the management's confidence of the company. Paying dividends means the management is confident about the cash flows of the company, and also the company can meet the future dividend expectations also, which means the company is expecting to grow. So the dividend growth signals the stability of the company for the investors. So in order to make the decision based on the dividend, investors should look into the ratios which are related to dividends. So they can use dividend payout ratios. It shows how much the company is paying as a dividend out of the total earnings of the company. So higher dividend growth means those stocks are ideal for investments. Up to now, we discussed about factors that help to spot a good stock, which are quantitative, those are measurable through financial statements, and there are also other qualitative factors. These are not measurables, but just by looking at the company's current position and the company's past history, we can decide on the future growth prospect of the company. There are so many qualitative factors, but I have summed up them into main two qualitative factors. First thing is competitive advantage. Competitive advantage is the factors that gives a particular company a competitive edge over its rivals. So in financial statements, you may sometimes find words like patents, royalties, and also the market leader. Through these words, an investor can identify the company's strength over its rivals. So, any company can get competitive advantage over rivals through various factors, through its brand. If a company has a good brand, everyone get to know about this company. Automatically, it gains a high market share, and also its market prices started to increase. And the other thing is supply chain. If a particular company has a good supply chain, which means the company can get its supplies at a lower cost. So it means the company can produce lower cost, which means it gives it a real power. The things are patents. These patents give the company the strength of charging higher prices, and also it helped to protect the market share of the company. Through this competitive advantage, a company can protect its market share, its growth, and also the profit. If a company can protect its profits, mean shareholders also get the benefit of these profits. Company's management means the ultimate decision makers of the company. If the management doesn't take good decisions, it will leads to company's failures. So even if the company has a competitive advantage, if the management doesn't lead the company in the correct path, it results in company failures. So who like to invest in companies which are failures? If the company's management owns shares themselves in the company, they will never let the company to fail, which means you as a shareholder also get a good return from the management decision. So you can look whether the management hold the shares of the company, and also we can identify whether the management is investing money or wasting money. They are investing money wisely. We can see that companies growing, profits are growing, revenue are growing. So through financial statement analysis, we also can decide the management's capacity. Today I explained some qualitative and quantitative factors which will help you to spot a good stock if you are investing in share market or expecting to invest in share market. I think this will be useful for your future investment decisions. Thank you.